What if you could peek over the shoulder of the world's smartest investors and see exactly where they're placing their bets for 2026? Some of the biggest names are quietly shifting billions, and their stock picks reveal surprising opportunities in a market many consider uncertain. From giants in tech to niche plays in offshore drilling and healthcare, these investments don't just reflect trends, they show where super investors see value that most people miss. Understanding their moves could help you make smarter decisions and maybe even grow your portfolio in the new year. The power players' recent moves. 5 of the world's top investors have made intriguing moves that could shape 2026's market landscape. Each of these super investors brings a distinct approach, ranging from deep value to concentrated bets on major tech giants. Their recent purchases reveal where they see hidden value or long-term growth potential, even when broader market sentiment feels uncertain or cautious. While we won't dive into all the details just yet, their collective activity hints at both opportunities and risks that could influence your investment decisions. What makes these moves especially compelling is the diversity of sectors and strategies involved. From mega-cap technology names to niche offshore drilling and healthcare plays, these trades span different risk profiles and market cycles. It's a reminder that smart investors don't just follow trends, they look deeper, evaluating fundamentals, cash flow, and competitive moats that most might overlook. Their choices set the scene for a closer look at where value might be hiding as 2026 unfolds. The real insight comes from understanding why these investors are putting their faith and considerable capital into these companies now. What drives their confidence amid shifting economic conditions? As we explore the individual moves, the rationale behind their bets will start to clarify, revealing themes that could guide anyone serious about investing wisely in the new year. One of the most striking bets was made by Bill Ackman, whose enthusiasm for Amazon stands out sharply amid broader market skepticism about the stock. Bill Ackman's big bet on Amazon. Bill Ackman, through his hedge fund Pershing Square, dramatically increased his position in Amazon, allocating nearly 9% of his portfolio to the tech giant. This sizable stake is striking because Amazon's stock price has been relatively stagnant compared to other tech giants, rising just 40% over the past 5 years. Despite this modest share price performance, Ackman's conviction rests on Amazon's impressive earnings growth, from $21 billion in 2021 to $76 billion more recently, and nearly doubling its revenue to $690 billion over the same period. Ackman's investment philosophy focuses on companies with sustainable competitive advantages, businesses with strong cash generation, clear growth trajectories, and significant barriers to entry. Amazon fits this mold by dominating e-commerce and expanding its cloud business, while steadily improving profitability. Ackman's belief is that Amazon remains undervalued relative to its fundamentals, making it an attractive buy even in a crowded and competitive market. What makes this bet especially interesting is the contrast between Amazon's past share performance and its current underlying business strength. Ackman seems to be looking well beyond recent price action, betting on Amazon's long-term growth and cash flow rather than short-term market noise. His move signals a clear message: fundamentals matter most for durable investment success, even if the market hasn't fully recognized it yet. While Ackman leans heavily into tech growth with his Amazon stake, another Bill Gates, is placing a big bet on a company with a storied past and evolving future. Bill Gates endorses Berkshire Hathaway. Bill Gates recently made a notable move by investing 7% of his portfolio in Berkshire Hathaway. This purchase stands out both for its size and timing. Gates had not made a comparable investment in 3 years since buying Microsoft stock in 2022. Berkshire currently trades at a price-to-earnings ratio of around 16, which many investors view as a rare bargain given the company's strong reputation and diversified business portfolio. Part of this low valuation comes from Berkshire's uneven net income history. Although the company recently reported an impressive $67 billion in profit, some previous years were weaker or even negative. Investor uncertainty has also increased following Warren Buffett's retirement as CEO, raising questions about how Berkshire will perform under new leadership. These factors have contributed to market caution and explain why the stock appears discounted despite its asset strength. Despite these concerns, Gates and his team believe Berkshire remains undervalued and capable of long-term growth. Their investment signals confidence in the company's resilience and ability to maintain its value-focused strategy even during leadership transitions. Next, we'll turn to a more unconventional choice made by Mohnish Pabrai. But before we do, like this video and subscribe if you're finding this useful. Mohnish Pabrai's contrarian pick, Transocean. Mohnish Pabrai, often referred to as the Indian Warren Buffett, is known for seeking deep value opportunities in overlooked sectors. One of his largest recent investments is Transocean Limited, an offshore drilling company operating massive rigs used for oil and gas extraction. While energy stocks are far less popular than technology names, Pabrai believes Transocean's fundamentals and market position make it an attractive long-term investment. A major reason for his interest is Transocean's low white space, which refers to idle rigs that generate costs without producing revenue. Unlike many competitors, Transocean has nearly all of its rigs contracted through much of 2025 and into mid-2026. This means consistent utilization and steady cash flow, with the potential to generate around $500 million in free cash flow even without new contracts. Another key factor is valuation. Transocean's net asset value is estimated at nearly $10 billion, while its market capitalization remains around $3.7 billion. This wide gap suggests the stock is trading significantly below its intrinsic value. For Pabrai, this combination of strong cash generation and discounted pricing represents a classic value opportunity that the broader market may be overlooking. The appeal of deep value in energy contrasts sharply with another sector facing pressure, but catching the interest of a famous contrarian, healthcare. Michael Burry's healthcare focus. Michael Burry, best known from The Big Short, has allocated a large portion of his portfolio, around 43%, to Molina Healthcare, a company that provides government-funded health insurance to lower-income Americans. While healthcare has struggled recently, Burry's interest reflects his deep value approach and belief that the market is undervaluing Molina's fundamentals. The stock has dropped roughly 61% from its highs, mirroring broader investor pessimism toward the sector. Despite the sharp decline, Molina's financial performance remains relatively strong. Net income decreased from about $1.1 billion to $880 million, but revenue more than doubled over 5 years, rising from $19 billion to $44 billion. The company also trades at a price-to-earnings ratio near 10, well below the market average, making it appear inexpensive for a firm with stable cash flows and significant scale. Burry's investment reflects his contrarian philosophy, targeting companies facing negative sentiment where prices may fall below intrinsic value. His bet on Molina suggests confidence that the company can stabilize earnings or rebound, offering potential upside. It serves as a reminder that attractive opportunities often emerge where most investors hesitate to look. From healthcare back into the realm of tech and iconic names, the final investor on our list blends tradition with modern opportunity in a surprising way. Warren Buffett's surprising Alphabet buy. In the latest quarter, Warren Buffett's Berkshire Hathaway made a move that surprised many observers. Instead of focusing only on traditional or cyclical stocks, Berkshire purchased 17.8 million shares of Alphabet, Google's parent company. This investment represents about 1.6% of Berkshire's portfolio and was its largest new position during the period. Despite Buffett's retirement, the decision reflects continued confidence in businesses with strong competitive advantages and reliable cash flows, even within the technology sector. Alphabet, known for products like Google Search, Gmail, YouTube, Maps, and Android, has faced concerns about disruption from artificial intelligence and changes in digital advertising. However, its financial performance remains strong. Over recent years, revenue increased from around $180 billion to $385 billion, while net income rose from $40 billion to $124 billion. Annual revenue growth remains near 10%, impressive for a company often viewed as vulnerable to disruption. Buffett's investment suggests a belief that Alphabet's massive user base and market dominance will continue generating substantial free cash flow. The move highlights his adaptable strategy, prioritizing long-term business strength over short-term trends, even in rapidly evolving industries. These 5 super investors show us that smart investing goes beyond trends. It's about spotting value where others hesitate and having the conviction to act. From Amazon's resilience to Alphabet's innovation, and from deep value plays in energy and healthcare to legacy businesses like Berkshire Hathaway, their moves offer valuable lessons for navigating 2026. If you found these insights helpful, don't forget to like this video and subscribe for more expert investing strategies and updates.